Hello, and welcome to the Money Metaphors podcast with Jason Coddington. Jason, good to see you again. How are you?
Good, good. How are you doing?
I'm good. I'm good, thanks. So we're getting into summertime as we're recording this, and I love warm weather, so I'm really happy to have the snow behind me for the moment. So
Yeah, yeah. No,
I
that's
realize
good.
where you are, it's nowhere near snow. So
Yeah. Well, we got to go 2 hours to get our snow.
yeah,
So,
exactly.
uh,
That'd be fine by me as well, by the way. But
yeah.
but usually
Last year we still had it. Last year we had people skiing on Memorial Day. Just, it was slushy,
wow.
but people did it just to say they did it. I was able to snowboard in 2005 on Memorial Day here, but that's very rare. Very
That
rare.
would be a rare kind of thing. Well, one of the things that's not so rare because it happens routinely are presidential elections, and we're smack in the middle of the presidential election season. So you want to tackle that one in today's podcast?
Yeah, we've been getting questions about that in the office, and then if people see me on the street, if if Biden gets elected, should I put my money in cash? If Trump gets elected, should I double down, or should I also go to cash, or what should I do?
Yep.
And we get that a lot, and so we want to provide some guidance there,
No, I
and
think it's
what to
great
do.
because I think it's on everybody's mind, to be really honest with you.
Yeah, and then a lot of it, and people I think forget. I think it's always nice to have a refresher on civics, but Congress has the power to tax. And so your congressional elections matter just as much. So
Yes.
if you're going to raise taxes, you need a Senate and House approved bill that of course then goes to the president for signing. So which we'll talk about that. So we have an upcoming episode that about some tax provisions that might go away next year
Yeah.
if Congress doesn't act. So anyway, but yeah, so presidential elections, what does that mean for investors? And we'll kind of give you some history, a little bit of some data. We won't prognosticate for you, um, and but we will give you some guidance that'll help you, I believe, have peace of mind as you move forward.
Well, I think probably the best place to start is the one where I even get questions about this one is it's a presidential election year. How do markets perform typically in election years? So I'm giving that to you because I don't know the answer to it.
No, that's great. I think the one, it's interesting. There's some data out there, we found BlackRock actually has some information. They have good educational information, and history would show that presidential election years are normally positive, you know. So um, it's typically, it's in whether it's the first quarter, second quarter, third quarter, or fourth quarter, historically speaking, average returns have all been positive.
Mm,
So I think that's interesting. Most people would think, oh no, it's been down. But every quarter in a presidential election year has had on average has been positive. So that's going back, of course, to 1926.
wow.
So and I think if you look at the whole in election year, on average, they've averaged 11.26%. So that's it's actually slightly better than average historically, all the way back to 1926. So presidential elections, historically speaking, are good um, for the stock market. So regardless of who wins. So
Oh,
that's some feedback there, I think, that most people don't know. So um and as of today of this recording, I think it's April 30th, end of the month. We're still positive year to date, so that at least as of now, if the picture was taken today, it's held relatively true.
that's true. Does it
Yeah.
matter? Do the outcome? I know elections matter. Do outcomes matter in terms of the market?
Yeah, so that's a great question. So there's a little bit of history on that. Um, and so I'd like to give you a little bit of that, and then I'm going to give you the long answer to that question.
Okay.
And so of course, if you have and this is going back now, let's see, what's my time frame? It's going back. let's see, 1910. This will be the Dow Jones we'll use instead of the
Whoa,
S&P
okay.
500. So Democratic president was a president 47% of the time in this past, 2020. And of course, the Republican president was president 52% of the time. I think the numbers are skewed because, Gerald Ford was not elected president. And, he wasn't elected as vice president, so
Yeah,
if you remember
right.
that, so that's thrown off a little bit in the data, the math. So people are like, how in the world? That's why. Um, so it's almost been 50-50, right? But Democrat president, the average return in that year had been 3.75%, and a Republican president 1.35% when they're elected, So
Hmm,
that's the Dow. So it's different data than we had for the S&P, but again,
right.
both positive. So really, and that's what that's going to tell you is there's a slight difference, but not too much. So that's one thing. And to kind of give you a difference, I think I talked about Congress earlier. Congress, 32% of the time it's been a Republican Congress, and the returns have been in that period of time average 6.52%. And then there's been times where it's been a Democratic Congress, and it's been 1.1%. And that's happened. Now, the interesting thing is we've had a Democratic Congress 52% of the time over the past, since 1910. So, interesting that we've only had a Republican Congress 32% of the time. And then we've only
Wow.
had, crazy enough, we've only had a split Congress, one way or the other, Senate or the House, 15% of the time, and the average return was negative. So there's all these, who's president, who's in Congress, all of that matters. Someone would say, well, if we have a Republican Congress, we're going to be good. Well, we're on the edge of that right now, but again, there's no forecasting. So, the House is really tight, and so is the Senate. So we could have a split, and I think, that is historically speaking. There's some interesting. There's one I like. This is one that Schwab did, along with Morningstar, and it's basically the one we like to tell people, because if you were only investing, this goes back to 1961, and you just put $10,000 in, and then goes
Gotcha.
back in, and
Okay.
so if you only invested like in and out, okay, when there was a Republican president, you would have $102,000 now. So 61 to 2023, so $10,000 grows to 102. Not bad, right? If you invest only a Democrat, so this will make my Republican friends mad, but if you invest only under a Democrat, that 10,000 turns into 500,000. So
Wow, that's
yeah.
unexpected.
Now
That's
keep in
crazy.
mind, Clinton was the president when we had the roar, the
Oh
tech
yeah,
boom in
the
that front. So
the great internet explosion. Yeah.
yes, he got most of that. So but here's probably the most telling, and probably what will lead into the rest of our conversation today, is if you just stayed invested from $10,000 from 1961 to 2023, if you just stayed invested, $10,000 invested in the S&P 500 would have been 5.1 million. So remember
Wow.
that. Only Republican 100 grand, investing only in Democrats 500,000, and if you just left it alone, it'd be 5.1 million.
Wow.
So I mean, you can probably guess where, with that data, what we're going to probably have you think about given a presidential election.
Don't
So
take your money out of the market. That
yeah, I think if you're, again, we've talked about this in most podcasts that we have, or most conversations, that you're the number one thing to do, irrespective of the market, or what's going on in climate that we're in. I mean, 4 years ago, we had a pandemic. We had we had April of 2020. It was, most towns were shut down, right? You couldn't
yeah.
go out. Now you fast forward, but we were relatively peaceful. We didn't have wars going on. Now we've got, a conflict in the Ukraine and Russia, and we've got the Middle East conflict, going on now. So, you just never know geopolitically what's gonna happen. We had low inflation in 2020. We have a relatively higher inflation. We had lower rates in 2020. So just in 4 years, a lot's happened, and you could make an argument that you should have moved and changed with your, your portfolio with the investment, but with the markets or the ideas. And our belief is, um, when we meet with people is, what are your goals, and allocate accordingly. We've used this phrase, we don't need to have money in the smartest place. We just need to have it in smart places. And what that means is have money, if it's 0 to 2 years, it should be in something safe like cash. If it's something 3 to 7, maybe something's, a little bit more return, also safe, maybe bonds. And if you go out 8+ years, it should be stocks or, equity type investments. So that holds true risk, always. And so now that we're highlighting and, zooming in a little bit on an election year, it's probably ever more, evident. And I will also say this, the average, I mentioned that the S&P 500 is positive during presidential elections, historically speaking, on average, going back to 1926. But one thing, and I'll bring this up now because we've had a little bit of this lately, on average, the market goes up and down with 14% in a year. Like, so what does that mean? That means it could go anywhere from 0 to 14, or 0 to -14. I mean, that's the standard draw. Now, some years are more, but on average, you need to expect a 14% drop, in the markets on an ongoing, any ongoing year. So,
Yeah, I was just going to ask you. I was going to say, to what degree do presidential elections if affect, investor sentiment, number one, and number two, market volatility? You just answered the market volatility one right there, it sounds like.
yeah, I mean, I don't have the data on the volatility in presidential elections.
Okay.
I don't have that. I do know, again, that varies. I think the the one I was in researching this topic a little bit, I've lived through this is my 28th year in the business, so I've been through a few elections doing this. In my first year, 96, that was Bob Dole, I believe, and Jack Kemp were running against Bill Clinton.
Yep.
And so, and you go back and you look, what's happened over those years. And I think there was volatility then,
Oh, of course. Yeah.
and then if you look, I was just going back to look a little bit, in 1987, I was in high school, but that's the nice thing about the internet and encyclopedias, which is you
I
can go
don't think
back
they
and
make
check. Yeah,
encyclopedias
I know,
anymore, do
it's
they?
so crazy. Who are those salesmen that came by with the 20 books in a wagon, right? So,
Yeah, exactly.
right, I mean, our family had them, so
Oh,
we,
so did mine.
yeah, the Funkin' Wagnalls, right? The almanac. Yeah.
I had
So
we had the Encyclopedia Britannica.
there you go. There you
Yeah, same
go.
thing. Yep.
But Ronald Reagan, he made a quote. They asked him on, I think the market drop, the crash of 1987, I think happened on the 19th, and on
Yep.
the 20th, they asked him what he thought. And I'm paraphrasing this a little bit, but his commentary, he said, you would think with the addition of 14 million jobs, lower interest rates, and lower inflation, the market would be positive. And so, that you just never know, right? I mean, you just never know how markets are going to react. And so the long answer there is, again, I think know your goals and stay invested.
And not be rattled by the volatility and the movement of the markets.
Yeah, yeah. And I think, I think that it's important. I think Congress, I think if I was looking at I think when we look at tax policy,
Yeah.
when we start planning for our clients, I think, yes, a conservative president is more likely to have, less likely to increase taxes. A liberal president would be more likely to raise taxes, but it takes Congress to get to that agreement, and on what that bill is going to look like. And so, I think who you elect as Congress is equally important. So, your vote matters there, because we see not so much investment policy, but we see tax policy come out through who's elected in Congress. And so, if we're looking at your investments there, and there's been rumors about changing some things, and making reducing the estate tax exclusion and all of that. And so, I think that's an important thing to consider is, um, Congress matters. But at the end of the day, I think staying invested is key. There's a stock market almanac that's published, and you can go back and look at history and try to glean glean, oh, this might happen or that might happen. And I liken that to buying, kind of one of those blackjack books.
Yeah, yeah.
I think, if you're
How to
dealing
win
with
at
it,
blackjack.
yeah, right. So are you dealing, but the biggest question to ask if you're going to use that book is how many decks are you dealing with? Because if you're dealing with 5 decks, your odds are statistically different than if you're dealing with 1 deck.
Exactly.
You know,
Significantly different, as a
yeah,
matter of fact.
20 queens versus 4 queens is a little
This is a
easier.
little different kettle. That's
Yeah.
a whole different deal. But it does raise in my mind, and you kind of hinted at this a moment ago, about, when you're in a presidential year, I think that you can't help but think about policy implications for who might win or who might get reelected, and sector rotation, because maybe where you start thinking about where are we in the economic cycle. So what about policy implications and rotating your portfolio?
Yeah, I think well, I think what happened, I think if we look back in this past election, Biden was elected in 2020, and relatively weeks, if not days after, you know, taking office, he closed some pipelines down, that raised the price of fuel, and that sparked, for lack of a better analogy, some inflationary items. And then we've had it ever since. We've had higher inflation for 4 years in his presidency. And that was
Well,
that was
and the fact that, he continued the increased spending that began in the last year, the Trump administration, in reaction to the pandemic.
Yeah, yeah. So I mean, we've had an increased money supply, and now that's tightening a little bit because it's we don't have the pandemic anymore. But then you had inflationary so I think policy matters.
Yeah,
But all that being said, you go back from if you go back to 2020, and from when he was elected to where the market is now, the market's higher.
yeah.
So even despite all the crazy policy things and the 2 wars we're involved in, and I'm not, I think, and I think this too is it's also important that historically conservatives have said we've been the ones that have focused on, or they've been the ones that have been focused on a balanced budget and uh amendment and all of that. And that's historically true. But I will tell you, the last time our country had a surplus was under Bill Clinton. Bill
Yep.
Clinton was president. You had a divided Congress and you had a surplus.
Yep.
So,
We did indeed. The last time we saw that happen.
I mean, we did have, I mean, under Bush's leadership, we did have, 9/11 happen, and there were some things that occurred extemporaneously, but that impacted deficit spending. But largely we were a surplus going into that presidency. So I mean, it's a fact. And I mean, I think we're gonna long for the days we can get back to a surplus in this country. So I don't know. That's how you should be voting, I think. Because that's multi-generational. It's not just that's for the future. That's
Well,
for
and
our
that's
kids. And
long-term perspective.
yeah, yeah, yeah. So, but I think so, it really kind of, it's whether it's, whether regardless of whether you're, you might be retiring next year, you might be retiring in 10 years, you might be sending a kid to college in 5 years, they might be, a newborn. Again, we're going to come back to if your money is aligned with where your goals are for your financial future,
Yeah.
presidential election, historically speaking, based on the data we shared today, regardless of the outcome, is not going to impact you. So you shouldn't, again, it doesn't mean you shouldn't have emotions shouldn't be fearful. because things happen in the news and that comes up, but it's just taking that real quick break to reframe and ask yourself before you sell everything and go to cash, or sell everything and take money out of your bank. We had some clients, take money out of the bank, like raw cash, and put it in a safe, years ago, because they thought the world was ending. And, we're all still here, and, not, that was against, of course, our advice, but that it made them sleep well at night. But we would argue that, a sound financial plan is to follow your goals. And, I think if you do that, you're going to be good in the long run, regardless of who's president. So, I think there's going to be a lot of chatter. You're going to hear a lot of things on the news, especially daily, from whatever political viewpoint you share. Things are going to be bad in the markets if one guy's elected. Things are going to be good if the other
Oh, yeah.
person's elected, and you're going to get both sides, and how you confused. And you know what? If and I like that sometimes, politics comes up at social events. And I would love for someone that's listening to this, if they're asking a question, well, if we do this, if you don't vote for, who would pick your president, for this president, the markets are going to go to, to hell in a handbasket. It would be nice to
Right.
just say, what I found is it doesn't matter. It doesn't matter. It just doesn't matter. I don't care who's president, at least for my money.
Yeah.
And I think Buffett too, I don't have his quote, he's got, it's hard to, don't bet against America. I mean, we've got our problems. Let's not be naive about that. But at the same time, historically speaking, corporate earnings over a 9% average per year for, over 100 years. And the rate of return in stocks have kind of followed that. And that's been through multiple world wars, multiple geopolitical events, assassination attempts, impeachments. You pick the crisis, and, the highs, there's highs and lows, but the lows keep getting higher. So
Yeah, I think a lot of people get nervous during election cycles. Understandably so, because the one thing that does exist that the market hates the most is the uncertainty of it all. But, I take your advice in the sense of, if we've got people listening to this who are a little nervous about everything, remember, reach out to your financial advisor and have a calm discussion with them, and remember the historical perspective that we've been discussing today. Um, it'll help keep you calm. It'll help keep you calm. And Jason, if people are listening to this who might need a little calming voice, might need to turn to somebody, how can they get a hold of you?
yeah, so you can give us a call, just 559-897-0040. We're Pacific time, so we're out here on the West Coast. And the other is, if you can visit our website at www.coddingtonwealthadvisors.com. We'll have an opportunity for you to just schedule a 15-minute phone conversation, where we can discuss, what questions or concerns you might have, and see, how we might help, and then decide our next course of action. But yeah, that's the best way to do that. And then, of course, we'll have some show notes and some resources for you here as well.
Yep.
So that would be the way to do it.
Very good. Very good. The other thing you can do if you're a listener and you haven't done so already is you can subscribe to the podcast. That's easy. You hit the follow button. That way you don't have to remember when, where you heard this, or, how often does Jason put out these podcasts. You'll be notified immediately, and you can listen at that point. I would also ask that if you like this podcast, share it with other people. We appreciate the word of mouth promotion. It's invaluable, as a matter of fact. Until the next podcast, I want to thank you for taking the time to listen today. I'm Bill Tucker, and on behalf of Jason and everybody at Coddington Wealth Advisors, thank you. And remember, you can go out today and make today a great day. Or not. It depends on you. Remember, you have a choice. Until next time.